So fine then, good morning. We'll just start our today's session. So we'll just go today with a new chapter, that is our Pgbp, that is profit and gains from business or profession. So profit and gains from business or profession usually deals with whatever the profit you get it out of your business, and whatever the profit you get it out of your business, either it is a profession. Suppose you are having a profession of a doctor, or if I take, you are having a profession of chartered accountant. So when you are having a profession of chartered accountant, you will be rendering the services to your clients. Okay. So when you are rendering the services to your clients, so then the clients will be giving you some service charges. So that service charges comes here with the profession. So that is what you study here under profit and gains from business or profession. So we'll just go with the theory part of Pgbp now. So coming on to our Pgbp. So what is a Pgbp? So we'll just go with the basis of charge. So before that, Pgbp will be starting from section 28. So till section 44D, we will be studying about your Pgbp. So these are the sections that we will be concentrating more over here. So in the first, we'll go with basis of charge. Basis of charge. So basis of charge will deals with from where we are going to put the charges for your Pgbp. So from where and all the Pgbp charges will be applicable. We study here basically the section 28. So the section 28 will always deal with the Pgbp. Coming on to this section will tell you that the profit and gains, or just take down the profit and gains. The profit and gains of any business or profession, of any business or profession which was carried on by the assessee, which was carried on by the assessee at any time during the previous year, at any time during the previous year, is chargeable to tax under the head, is chargeable to tax under this head. So nothing that I'm telling you over here. So just listen. So it is tells about the assessee. Assessee means the person who is liable to pay the tax. Okay, na? So if an assessee is getting some income, that he has got some income that is in the previous year. Say for example, if I take the current assessment year that starts from 1/4/22 to 31st March 23. Okay. For this, the previous year would be 1/4/21 to 31/3/22. Okay. In this year, whatever the profit he has got, on that profit, he will be paying the tax in this particular year. So that is what the basis of charge we are going to study here. Is there any doubt? Understood? Okay. So now we'll go with the next part. So the next thing is, come after your basis of charge, we have computation of income. Like how do we compute our income under this head? We'll just see that. Computation of income under this head. Okay. So under which head? Under your Pgbp. So under this Pgbp, how do we compute our income? So we have a certain format done for that, and this one we will be studying under our section 29. So under the section 29, we study the computation here. So coming on to that, so you can take a 2-column particulars and make the 1 more column as your amount column. Okay. So on the particulars, the first thing we take over here is profit as per P&L account. Profit as per profit and loss account. Whatever the profit, we have it on profit and loss account. That means for this, they will be giving you one balance sheet, or in the question they'll mention you. So that profit, as per your profit and loss account, you will be making a note over here. So for this, you will be adding a certain things. So what are the things that you will be adding here? The first thing, expenses or losses disallowed but debited in P&L account. But debited in P&L account. So you will take the amount in its column. Okay, you have some of the expenses, you have some of the losses, which is not allowed, which is disallowed, but debited in P&L. So you know that format. This is an actual format. So this is your debit side, amount, particulars, amount, credit side. So there are some expenses over here which is disallowed, but still it is there, which is debited over here. So whatever the things you get it over here on debit side will be your expenses. Understood? Okay. So now, apart from this, we have one more thing. So we'll just move on with that. So after your expenses, we will be again adding some of the incomes taxable. Take down incomes taxable as business income. As business income, BI represents business income. Okay, incomes taxable as business income, but not credited to P&L. But not credited to P&L account. Take the amount inner column. Okay. So income, some of the income which is usually taxable over here. So the incomes which are taxable over here as business income. Some business incomes are taxable here, but not credited to P&L. That amount will not be there in this balance sheet credit side, but that will be given in adjustments. So what usually happens over here? If I open the balance sheet for this year, I will be closing my balance sheet on 31st March of 2022. So after 31st March of 2022, after closing, some evening I had made some transaction that is taxable. Again, I cannot include it over there. Again, everything I have to do it from the beginning. So what I am going to do, I'm going to put that under the head of adjustment. In that I'll be recording. So those incomes also I'll be adding it over here. So again, for this, you will be adding expenses in excess of the allowed, expenses in excess of the allowed amount debited in P&L. So again, this will be there in the P&L account. Some of the expenses, you will be having more expenses. Excess means more here. So expenses in excess of allowed amount. In allowed amount also, there is some extra amount will be included. Even that amount you are going to add over here. And again, the last but not the least, you will take down in the addition, that is undervaluation. That is your undervaluation. Undervaluation of closing stock or overvaluation of opening stock. Opening stock. That amount also inner column. So undervaluation and then overvaluation. Just a minute, guys. So coming on to this, undervaluation or overvaluation. So here is your stock. For stock, you have some value. Okay. If the value goes up, we call that as overvaluation. If the value comes down, we call that as undervaluation. Suppose if there is undervaluation of closing stock, you will take it here. Suppose if it is overvaluation, you take it over here. Sometimes both the things will be there. It's very rare case that you have both the things, but usually you may have overvaluation or you may have undervaluation. Any one will be given to you over here. So that amount also inner column, you add all these things, you take it outside, and from this you add this amount, you take the amount over here. So understood? Okay, so I'll just clear your screen and the still format will be continued. So will just go with that continued format. We have added some things. Now we are deducting something. Below that, you just take down as less. And below that, you will be taking some points. And whatever the points that you will be taking here, that will be opposite to your addition. Okay. Say, for example, in addition, you can see you have expenses or losses disallowed but debited, disallowed but debited in P&L account. But what happens in less here? Expenses or losses allowed. Before it was disallowed, but here it will be allowed. There it was debited, but here not debited. Okay, na? So because I'll tell you. Okay, so we'll just make a note of that first. It's a continuation of your format. So take down below that less and then take down the first point in the less. Expenses or losses allowed but not debited to P&L account. Okay, you will take that amount again in the inner column. So what happens over here? Expenses and losses allowed but not debited. There it was debited, but here it is not debited. So this is the allowed expenses. Those are disallowed expenses, if you observe. Okay, these are the minor changes you have to notice, and you should be careful over here. So you can just remember allowed, not debited. In the before part, disallowed but debited. Like this, key points, if you remember, it will be useful to you. Expenses allowed but not debited. That means you can easily imagine this will not be in debit column in your balance sheet. This will be in your adjustment. And then you have the second one, incomes not taxable as incomes not taxable as business income but credited to P&L account. So amount inner column. But if you observe in addition the second point, income taxable as business income but not credited. Okay, but here income not taxable. Here it is not under the tax head. It is not taxable as business income here, but it is credited to your P&L account here. So that means you can easily imagine it is credited. That means obviously it will be there in the balance sheet on the credit side. So you take the amount in the column, and then the third one, income exempt from tax. Incomes exempt from tax but credited in P&L account. That is nothing but some of the incomes are not included in the tax. They are exempt from the tax, but still it is credited in your P&L account. So that also you will take, but credited in P&L, you can easily imagine it is there in the P&L account. And last but not the least, here you will take down overvaluation of closing stock and undervaluation of opening stock. So whatever we took over that, it was ulta there. If you see, undervaluation of closing stock was that, but here we are taking undervaluation of opening stock. That overvaluation of opening stock was there. Here we are taking the closing stock, and all this amount you put it here. You add this amount, you take it outside, and you had a balancing figure now, the last one. So from this, you are going to minus this amount, and whatever the balance you are going to get here, that will be your taxable income from business or profession. Understood? Is there any doubt? So this is the actual format. The simple way to understand this format, whatever the things are there in the addition, you study that properly so that easily you can write down the less parts over here. Okay, I hope you both have understood in the online. If you are, just give me a thumbs up. Okay. So now I'll go with the next part in this. The next part that I'll be going on here is allowed deduction. Some of the deductions that we are going to allow here in Pgbp. that allowed expenses you will be knowing over here. Okay, what are all those things? We'll just see here. Expressly allowed deduction. Next heading. Expressly allowed deduction. Expressly allowed deduction. We are going to check over here. What are the expressly allowed deduction? Let us check that now. Suraj. So coming on to this expressly allowed deduction, we have a certain points under the certain sections. We'll just see that one by one. First thing, expenses of business premises. Expenses of business premises. So the expenses of our business premises, we look at this under our section 30. Section 30 will tell us regarding the expenses, whatever it's going to happen in the business premises, in the area that has been allocated to the businesses over here. So what are the expenses of business premises? So here the business premises expenses, what we are going to do, how we are going to treat. So you can just take down. Deduction is allowed in respect of rent. Deduction is allowed in respect of rent, comma rates, comma current repairs, and insurance for building that are used by the assessee, that are used by the assessee for his business or profession. For his business or profession. Okay. So just listen to me now. Expenses of business or premises. Coming on to this, we study this under our section 30. So what does this thing is going to tell you? Deduction here we are going to allow. So that means we are going to do a certain amount of deduction in respect of the rent. If you are paying the rent, we have a certain deduction and we do that certain deduction if you are paying the rent. And the rates is nothing but some taxes amount. In that also we do a deduction. Current repairs, there is some repairs. Even for that repairs also we do a deductions here. Apart from that, if you are paying some insurance, and in that insurance also certain deductions will happen. And for building here comes like you will be having a painting for building, some kind of minor renovations for the building. Even that situation, there will be a certain amount of deduction will be made. And all these things will be used by the assessee. That means the person who is liable to pay the tax. So he will be using all these assets for his business or for his professional purpose. He will be using that. On all these things, we do give a deductions over here. So I hope you people understood. And in this only we have a next thing, expenses of business assets. How do we treat an expenses of business assets? The assets related to a business is what we call it as expenses of business assets. So this we studied under our section 31, expenses of your business assets. Take down this section. This section allows deduction in respect of expenses, on current repairs, insurance of plant and machinery and furniture used for business or profession of the assessee. Here everything comes under the assessee only. whatever the business the assessee is going to do, whatever the profession is going to do, on that only we will be giving some deduction over here. So we usually allow the deduction here, that is in respect of expenses on current repairs. What do you mean by current repairs? Every time it will be occurring over here. So that is what the expenses that you are going to get it on current repairs, or insurance of plant and machinery. Every year you will be paying that. Again, it is an expenses related to your business assets, plant and machineries and business asset to you. And in the same way, coming on to furniture, some polishing may happen or any kind of repairs may happen related to our business assets again. So whatever the income that you get it, that means whatever the assessee is going to use that furniture or the assets either for his business or for profession, again on that we will be allowing the deduction on it. Any doubts in this? Understood?
If the company, the person buys the name of the company, will he get deduction for it?
In the name of the company, if an assessee is buying, reduction will be there in that. For his personal use, is buying, no kind of reduction.
He buys it, the name of the business, but he uses it for the personal use.
Then for the personal use, certain deductions you will be having. Okay.
It isn't illegal.
It is. So now I'll just clear this and now we'll go with the next part. Yeah. So after this, we are having an depreciation. It's an important concept to you people. So that is, again, depreciation is also comes under expressly allowed deduction. So depreciation here comes with your section 30. Okay, this is an important concept in this chapter, the depreciation. So coming on to our depreciation, so usually here we'll be having a compulsory deduction on a depreciation in whatever the amount of depreciation is going to happen. And here depreciation is going to happen based on the income tax rules, based on the IT rules, we'll be giving an depreciation. So for the depreciation, again, we have a format, take down below that. Particulars, amount. So in the particulars, the first thing we are going to take, opening written down value, opening WDV, you will take one amount. For that, you will be adding the assets acquired and put, assets acquired and put to use, put it to use for 180 days or more. Okay, so if you have acquired some assets or if you have purchased some asset newly and you have used that asset more than 180 days. So if it is more than 180 days, you take that amount over here, you will add with your opening WDV. Again, for that, you will be adding the assets acquired and put to use for less than 180 days. Okay, so whatever the assets, that means you clearly you can make a note that whatever the newly assets that you have brought into your business, you will be adding that amount with your opening WDV, and after adding you will get one balance. Okay, for that balance you will be minusing net sale proceeds during the year. During the year you will minus this amount, so then you will get one balance. So that balance is what we call written down value for depreciation. Okay, so either in these two assets you had sold some assets, or previously you had some assets, you had sold that asset. So here in the net sale, we usually consider the date. Okay, suppose if you are selling the asset by January, so till January you give the depreciation and then you are going to write your sale proceeds or the sale value. So once you add your purchase and minus your sales, your actual value will be WDV for your depreciation. And for that, for the whole year, whatever the depreciation is there, you will minus, that is depreciation for the year you will minus that amount. So then you will be getting a last balance. So that is what we call it as closing written down VAT. Okay, so this is an actual format we use when you wanted to make an depreciation amount. Opening WDV, for that you will add your purchases minus sales and then minus depreciation for the year. Is there any doubts in this? Understood? And while doing your depreciation, even we will be considering a certain conditions. Okay, so then what are all those conditions? We'll see. Conditions for depreciation. Okay. So we'll see these conditions related to our depreciation one by one. So here is the first condition. Even conditions are important. They might ask you in fill in the blanks or in MCQs or anything. Okay. So coming on to this condition. So here the very first condition will be telling you that assessee must be the owner of the asset. Assessee must be the owner of the asset. If the asset belongs to me, if I am an assessee, if the assets belongs to me, then I'll be called as the owner of that asset. So usually on if an assessee is the owner of the asset, then only we give certain deductions in the following cases of depreciation. And also whatever the assets that I am having here, either I have to use that asset for my business or for my profession, that is in the previous year I have to use that asset. Okay, so the next point here, it will be telling you regarding take down where an asset have been acquired during, where an asset have been acquired during the previous year and put to use for less than 180 days during the previous year, then only, this is important again, 50% of the prescribed depreciation of the prescribed depreciation shall be allowable. So what we are telling over here, suppose you have purchased some new asset and you have used that asset less than 180 days. If it is less than 180 days, in the depreciation, only 50% will be allowable for your deduction. The remaining thing is fully taxable over here. If it is only less than 182 days, so less than 182 days, 50% of prescribed depreciation will be allowed over here. And in the same way, take down the next important point. If an asset is capable of being used, it is still considered as put to use. So what they're telling over here, suppose I'm using the bench for nearly 10 years and more, still the bench is in a good condition, I can use it for further. So what I can do, if asset is capable of being used, if it is capable or if it is in good condition, I can use it, then I can consider that as put to use. That means I'm still using that. I can consider that as still I'm using that particular asset. The last point over here.
180 days, is it the working days or the purchase?
Purchase fees. So coming on to the next point, the last point, that is, there is no question of profit or loss on sale of loss on sale of individual assets. Okay. Suppose if it is a individual assets, so here there is no question whether we will get a profit on that or whether we'll get a loss on that. We won't consider that. We just consider the asset over here. Okay. I hope you people have understood. So this is your first part.